President Trump is really pushing the envelope on economic growth and a pursuit of 4 to 5% GDP growth. He is Twitter storming the Federal Reserve to send interest rates lower again and to embark on QE4. This is madness. In fact, Wealth Research Group sees this as a major turning point. Until now, QE programs have been drawn up to spark economic growth when there was none, when central banks were combating deflation. Here's the first scenario where QE is used to achieve maximum inflation and peak capacity. In this interview, John Rubino discusses these key points and more as he gets asked questions he's never answered before on any other show. Enjoy this one.
Welcome to the Tons of Industry Show. I'm very excited to interview for the first time Mr. John Rubino of dollarcollapse.com. And one thing that gets a lot of people confused and baffled is the discrepancy between official CPI numbers, the inflation numbers, and the change that people are actually feeling in their standards of living for the past 20, 30 years here, and especially in the past 10 years. America exports the ideas of democracy for the rest of the planet, but in order to project that image, ever since the end of the Second World War, they've created a web of military-industrial complex, which is now termed the deep state, and it is for a reason. The people in these positions and agencies are embedded much deeper than the revolving door politicians that we've seen over the years. Well, these people don't change for the most part. At the center of it all is the measuring sticks of all transactions, of all commodities, of all goods and services and equities and bonds, and it's the U.S. dollar, which is used for 61% of the world's transactions worldwide, on the biggest levels and down to the retail person. And understanding the dollar is understanding the world of investing. For example, in 2018, the dollar was the best performing asset in the world, which is very unusual. And for the past 8 years, despite massive stimulus, the dollar index has actually been on a cyclical bull market compared to other currencies. So John Rubino is the perfect expert on the dollar, and that's why I wanted to have him on today with us. And with Q1 behind us, John, it's a great time to have you on. Pleasure to have you on, sir.
Thanks, Lior. It's good to meet you.
It's good to meet you too. And I want to ask you, let's start with President Trump. Did you hear the latest from him regarding his demands from the Federal Reserve to cut interest rates as soon as possible and even embark on QE4, which is the polar opposite of financial tightening? So what do you think of these two things, QE4 and lowering interest rates?
Well, first of all, Trump lobbying the Fed to give him these things is nothing new historically, and it makes a lot of intuitive sense, right? If you're the president, you want low interest rates because that makes the economy a little stronger than it would have been, and it gets you reelected. And he's heading into what's going to be probably a really tough election campaign. So naturally, he wants lower interest rates. Now, previous presidents have lobbied the Fed for favorable policies in the past, but they tend to do it behind closed doors. Ronald Reagan, for instance, is was supposedly really angry at Paul Volcker for interest rates being so high in Reagan's first term. But their conversations took place maybe in the Oval Office or someplace where there weren't any press. Trump comes out, stands before cameras, and tells the Fed what to do. And that's unique, but it's also Trump. It's his personality to say what he thinks and to demand what he wants from the people who work in the government and do it publicly. So that's not a big deal. As for whether interest rates going down are good from here on out, or whether a new round of QE is good, they're very bad, and they have been very bad for the past 30 or so years. We've kept interest rates at artificially low levels. And since interest rates are the price of money, when you lower the price of something, people tend to buy more of it, right? So we've encouraged huge amounts of debt to be created, not just at the government level, but at the private sector level, pretty much across the board. Corporations have record debt in the US. Credit card debt is at record levels for individuals. Car loans are at record levels. Student loans are at record levels. Mortgages are high, although they're still below the peak bubble level of a decade ago. But the result of this is that you get a really high leveraged society that is super fragile financially. In other words, any little thing can send this currently over leveraged system into a tailspin. And so the governments of the world know this and they're terrified. But as for whether we're going to have these things, lower interest rates and QE, that's a given, because the global financial system is so highly leveraged that it can't handle higher interest rates. And even current interest rates may not be enough to keep it from tipping over into recession. And it's a global recession, not just the US. And the next recession will come at a time of so much bad debt that's been created out there in the last decade that there's no way to tell whether it stays a recession. In other words, we get a couple of years of negative growth and then things pick back up again, or whether it turns into something much more serious. And I think there's a good chance that the next recession, unless it's met with extremely aggressive monetary and fiscal policy, has a big risk of turning into a 1930s style depression, just because so much bad debt is out there to blow up on us. And once some of it starts to go, a lot of the rest will go. And the government knows this, so they're preemptively easing now. The Bank of Japan and the European Central Bank are already aggressively easing. And this is 10 years into a recovery without a recession taking place just yet. The Bank of China is aggressively easing, and that's what the Chinese economy is still growing 4 or 5%, according to official numbers. And the US, which is the only central bank that tightened it all, is now done with its tightening and getting ready to start easing. So within a year, we will be back in global coordinated easing and probably aggressive asset purchases, which is what QE is. So we're going to be like 2009 again, but with an economy that hasn't dipped into recession yet. The labor markets in the US, for instance, are pretty tight right now, and wage growth is starting to accelerate. So if the government eases aggressively and manages to hold off the next recession, then they'll be doing it from a point where there's already accelerating inflation and already extremely tight labor markets, and still rising home prices and strong oil prices, et cetera, et cetera. So they'll be doing it from a place where there's already inflation embedded into the system. And that's new. You know, that's a new experiment with monetary and fiscal policy, which almost certainly can't end well, right? If we're going to try to generate higher inflation when inflation is already trending upward, we might get what we want, but we won't want it once we get it. Rising inflation is something that mainstream economists consider to be a good thing while it stays within a range of 1% to 2%. Let it break out above that, and it will spook the financial markets, which will take us back to maybe the 1970s currency crisis, when interest rates had to be moved up to like 15 or 20% in order to stop the inflation that was building at the time. We can't do that now. So if we head back into a period of inflation, we have no tools left with which to combat it. And that's a recipe for currency crises around the world. And that's kind of the dollar collapse thesis. It's not just about the dollar. It's really about the concept of fiat currency, which has kind of run its course. We've given ourselves unlimited printing presses, and we've, of course, abused that power. And now we're towards the end of the process of taking on enormous amounts of debt and creating huge amounts of new currency in order to service the debt. That's something you can only do for so long. And it seems that we've done about as much as we can do. So the next cycle is liable to be one for the record books, something that is just so chaotic that historians will be writing about it for the next century.
John, you bring up a number of important points. One of them is I feel like if you ever driven exotic cars, that you need to brake as late as you can into a corner, not too early, but not too late where you entirely miss that corner and then you can't accelerate on the other side. And I feel like Trump and the Federal Reserve are trying to see, hey, where do we break this corner? And Trump looks like he wants some more gas. and that's very risky before a corner because you can hit the pavement and all that kind of stuff. And the Fed might be on the flip side trying to break too early. It's a very delicate game. And obviously, I haven't seen any race car driver in history take a perfect turn. So it's a very unique situation that you bring up. If they loosen monetary policy in the U.S. right now, they risk higher inflation. They also risk the fact that come the next recession, they'll have less policy tools on the monetary side to lower interest rates, etc., and stimulate the way that they've done because they're starting from such a low starting point. There's so many things to talk about with that in mind, and I want to ask you, what do you think about the relationship between the performance and the confidence both foreigners and domestic institutions and individuals place on the dollar, given the this back and forth between Powell and previous Fed chairs who are coming to speak on his behalf, which is very new. Where you see them, they call these previous chairs like Yellen and Bernanke to kind of give Powell some good leverage on the media, and they're versus the Kudlow Trump duo who are pushing hard for lower interest rates. What do you think the actual debate, the actual Twitter storm, the actual media frenzy around it, what do you think its effects are on confidence? Because if I see a married couple and they're arguing in public, it doesn't give me a lot of confidence in their marriage. If they're, like you said, arguing in the privacy of their own home, they can masquerade a happy marriage. And it doesn't look like they're trying to masquerade anything. It looks like they're trying to create this situation where it's out in the open to achieve better results, at least from Trump's side. So, what do you think this projects to the rest of the world? That they're adamant about finding a solution, or that the solution is very difficult to find?
Well, I think there's a very funny paradox here with the dollar, which is that the crazier things get in the U.S., the higher the dollar goes. And the reason for that is that turmoil in the U.S. causes even bigger turmoil outside of the U.S. So if we have problems here, that means the whole world has even bigger problems because they're also dependent on us for one thing or another. Europe needs us for defense and to buy their stuff. Japan and China desperately need us to buy their stuff. And if anything tricky happens here, they suffer more than we do. And because of that, they tend to want to own treasury bonds, which, with them suffering more than us, look even better as a safe haven than their own currencies. So trouble in the US actually makes the dollar stronger. And another paradox is that rising US debt or dollar denominated debt makes the dollar stronger because it creates demand for dollars. In other words, if emerging markets borrow $10 trillion in the last few years, which they kind of have, then they have to come up with hundreds of billions of dollars to pay the interest on the 10 trillion that they borrowed. So it increases the demand for dollars, which pushes the dollar up further. So it sounds a little bit like a perpetual motion machine when you hear it put that way. In other words, the worse we behave, the better the world treats us by bidding up the dollar. But what it really is an incentive for us to borrow even more. It gives us a chance to behave even more badly than we would have otherwise. For instance, in a world where if we were borrowing too much money, people would sell the dollar. That's what happened in the early 1970s that caused us to leave the gold standard. People were converting their dollars back to our gold and asking for our gold in return. And it got to the point where we couldn't handle that anymore. We didn't want to give all our gold away or increasingly worthless dollars. So we closed the gold window, put everybody on a fiat currency standard. Now we've got kind of the reverse of that. We're on a fiat currency standard, and the worse we behave, the stronger the dollar gets. But that is not a permanent state of affairs because at a certain point, our behavior becomes so outrageous and so dysfunctional that people really do stop wanting to hold dollars. And it might be Americans who do that first. There's a concept in the Austrian School of Economics called the crack-up movement, which is basically when a critical mass of people figure out that it's official government policy to devalue the currency year after year after year with no end in sight. And they decide they don't want to hold that currency anymore. So they start buying real stuff with their currency. When they get paid, they immediately convert it into currency and then go out and buy farmland, rental properties, gold and silver, really high quality blue chip stocks. And that causes the value of the currency to start to fall at an accelerated rate and puts it in kind of a death spiral where it's falling, nobody wants it, they bail on it, that makes it fall even further, and then you get a hyperinflation. That's the scenario that we're staring at somewhere out there in the future, with all the governments of the world behaving as badly as we are, with one difference. In the past, lots of countries have gone through this. Where they borrowed too much money, created too much currency to cover their debts, and the currency value plunged, and they had a hyperinflation and hit rock bottom and then started over. If you Google list of hyperinflations, you'll see that a lot of brand name countries are on that list, including the US and Germany and France. And, a lot of countries that, while not in, say, Germany's class, are still, legitimate countries that you wouldn't expect to have hyperinflations, but they had them in their past. So it's nothing theoretical or mystical magical or even ideological to say that we are headed for something like that, because we're making the same mistakes these other countries made in the past, which led to that outcome. What's different this time, though, is that in the past, those were one country specific hyperinflation at a time in a world of mostly sound money. Everybody else was on the gold standard when most of these things took place. Nobody's on a gold standard now, and almost everybody, with the exception of Russia, interestingly, everybody's making the same mistakes, borrowing too much, creating too much currency, and basically screwing up the value of their currencies. So we're all headed off the same cliff simultaneously, and that's new and different, which means you can only rely on history for part of what's coming. But a big part of it will be newly written history. In other words, an experiment that took us into uncharted territory and therefore has an uncertain outcome. But I think you can say with some certainty that the outcome will be tumultuous. Volatility is almost the only thing that's guaranteed about our coming decade.
Well, you bring up a very important point. One, the globality of the problem. So it's not an isolated problem. It's really a game of hot potato. It's the currencies are floating against each other. One is always better viewed. One is lesser. Not as people don't have confidence in it. But the gold trades at all-time highs at 72 currencies right now, which is astounding. And what I want to ask you is the yield inversion that we just saw, the yield curve inversion, like clockwork, there's never been a time that a recession hasn't followed in 12 to 8 months. So markets are obviously anticipating this now. I don't know if they're pricing it in, but they're certainly thinking about it because for everyone who watches a chart, the yield inversion is interesting. How can the Fed counter the next recession in their normal monetary tools? Do you think that there's enough political capital for them to go ahead and bail out, again, the system? Do you think that the American people will stand for it? Do you think that the institution will stand for it? And how will this happen? Because Wall Street, this revolving door of Wall Street and the government just doesn't look good anymore. And I don't think that Wall Street will like to put themselves in bed with the government again, because it will just create so much backlash, far more than we saw in 2008. So what do you think are some of the creative tools that they'll use? Or do you think that we're going into an austerity measure period where you're going to see something more the likes of what we saw in Europe?
Well, that's part of the uncertainty that makes what's coming so interesting. They will absolutely try to bail out everybody in sight when the next downturn comes, because the alternative is to let some big players go bankrupt, which will cause other big players to go bankrupt, and so on, until the system just collapses under its own weight. We have vastly more debt now than we had in 1929. And the stock market crash back then, along with some bad Federal Reserve policies, produced the Great Depression. So it's easy to conceive of the amount of debt that we have now, which, if you include derivatives and unfunded liabilities, is multiples of 1929's debt. It's easy to believe that a recession that causes a lot of big players to go bankrupt could turn into something much, much worse. And the government can't handle that, because then the guys in charge will be this generation's Herbert Hoover. In other words, the guy who caused the Great Depression. They don't want that. They don't want that to be their legacy. So they will do anything to try to avoid that. And anything will include, I'll go out on a limb here and say it will include bailing out 5 or 6 big states, including Illinois, along with some cities like Chicago, bailing out some big banks because their derivatives books blow up, just like they did in 2009. Bailing out some other countries because so many emerging markets, for instance, have a lot of dollar debt, and they can't pay it because their own currencies are falling versus the dollar. And in a US recession, it would be that much worse for them. So we'll have to bail out some of them, because allowing any of them to blow up might take the rest of them down and give us a global depression. So they will try to do that. But the one thing they can't control, they can control the amount of money that they can create. To an extent, they can control interest rates via QE and other financial repression policies. But what they can't control is the value of their currency on the open market. As we're seeing with, for instance, Venezuela, once people lose interest in a currency, there's really no going back. They dump it as soon as they get a hold of it. And inflation goes from single digits to double digits to triple digits into the hundreds of thousands of percent a year, like we're seeing in Venezuela, and like we saw in Zimbabwe just recently, and like we'll see in a lot of countries going forward. So that's probably the way this goes. We will try to bail out the first batch of big entities that blow up. And again, I think it's Chicago, followed by Illinois, followed by a lot of the muni bond market, followed by a lot of the emerging markets, and then probably Europe, China, and Japan are in that mix somewhere. So when we start trying to bail all these guys out, people will finally, at some point in the process, figure out what that means for the currencies that we're using to bail these guys out. And that'll be the end of the game. Once you lose a stable currency, you can't manipulate a financial system anymore. And that's not just the US, it's not just Europe, it's the whole world.
Okay, now I want to ask you this. So what we're seeing is a situation where I want to talk a little bit about gold, the poster child of hedging for inflation, hedging for crisis, hedging for a currency reset, etc. How much gold should people own in terms of the physical? Should they own ETFs? What do you think of it as part of a portfolio? Obviously, it doesn't pay any yield, doesn't bring any cash flow. It's cyclical. So it's not something that you hold forever and it just continues to retain value and has big swings. In the past 48 years, it's grown on average 6.6% a year, which is great. But obviously, you had a 20-year bear market in the middle of it. You had a 6-year bear market just recently. What's the best strategy that you've seen in order to capitalize on precious metals? And to safeguard your wealth by using precious metals? Do you use both gold and silver? Just talk about your strategy overall and what has worked for you.
Well, start by not thinking of gold and silver as investments, at least in bullion form. For instance, as a gold coin or a silver coin, they are money, which means they don't compete with Amazon stock. They compete with the dollars in your wallet and in your bank account. And in a time when dollars are being mismanaged, it makes sense to replace your dollar savings with gold and silver because they're forms of money that governments can't create more of. So instead of having a big dollar bank account and a bunch of dollars under your mattress or stored somewhere else in your house, you should have.
In the past few weeks, some great shows have been published with Mark Faber, who was anything but politically correct, so definitely check that out. Wealth Research Group interviewed Harley Schlanger, who talked about the rise of socialism and other problems in Europe. Jeff Berwick, who straight on hates any sort of government, and Ben Perrin, who discussed the bottom for Bitcoin. Huge shows are coming up as well. Make sure you download the exclusive report on the feud between Trump and the Fed at wealthresearchgroup.com/enemy. Thanks for tuning in.